Welcome back to the channel, everyone. Today, we're diving deep into the world of finance and uncovering the top investment trends that are set to reshape the Indian market. Whether you're a seasoned investor or just starting out, understanding these trends is crucial for making informed decisions and maximizing your returns. We're talking about the forces driving massive shifts in the market, from foreign investment pouring into India to the hottest sectors everyone's watching. We're going to break down complex financial concepts into bite-sized pieces that anyone can understand. So if you're ready to level up your investment game and capitalize on the incredible opportunities in the Indian market, grab your notebooks, hit that like button, and let's get started. Alright, let's kick things off by talking about the elephant in the room, foreign portfolio investments, or FPIs as they're commonly known. We've been seeing a massive influx of foreign capital into the Indian market recently, and let me tell you, this is a huge deal. Think about it. When foreign investors put their money into India, it's a sign of confidence in the country's economic growth and stability. This surge in FPIs inflates stock prices, boosts the value of the rupee, and fuels overall economic activity. But here's the catch, it also makes the market more volatile. Why? Because these foreign investors can be fickle. If they sense instability or better opportunities elsewhere, they can pull their money out just as quickly as they brought it in. So, while this influx of foreign investment is exciting, it's crucial to stay informed and diversify your portfolio to mitigate risks. Don't put all your eggs in one basket, especially one that's heavily influenced by the whims of foreign investors. Remember, knowledge is power, and understanding the dynamics of FPIs is crucial for navigating the Indian market effectively. Now let's shift gears and talk about the big boss of the Indian financial system, the Reserve Bank of India, or RBI. What they do has a ripple effect on literally everything, from interest rates to the availability of credit. One of the RBI's key tools is its open market operations, where they buy or sell government bonds. When the RBI buys bonds, it injects liquidity into the system, making it easier for banks to lend money. This can be great for businesses looking to expand and for individuals seeking loans, but here's the thing, increased liquidity can also lead to inflation. Imagine more money chasing the same amount of goods and services, prices are bound to go up. So, the RBI has to walk a tightrope, balancing growth with stability. And then there's the repo rate, which is the interest rate at which the RBI lends money to commercial banks. A lower repo rate makes borrowing cheaper, stimulating economic activity. But it can also devalue savings. The RBI's actions have a direct impact on your investment portfolio, whether it's through interest rate changes, bond yields, or overall market sentiment. So keeping an eye on their announcements and understanding their policy decisions is absolutely crucial. For years, investors have been chasing growth in emerging markets, and India has always been seen as this sleeping giant, right? Well, guess what? The giant is waking up. We're seeing a huge shift towards domestic sectors, and for good reason. India's population is young, aspirational, and increasingly tech-savvy. This translates into a massive consumer market that's hungry for goods and services. We're talking about everything from smartphones and automobiles to healthcare and financial products. And it's not just consumer spending that's driving this growth. The government's Make in India initiative is incentivizing domestic manufacturing and attracting foreign investment in key sectors. This focus on self-reliance is creating a more resilient and sustainable economic model. So, whether it's technology, healthcare, infrastructure, or consumer goods, the opportunities within India's domestic sectors are vast and diverse. This is where the real long-term growth potential lies, and smart investors are taking notice. Now let's talk about a potentially controversial but undeniably fascinating trend: the potential opening up of the nuclear energy sector to foreign investment. This is a big deal, and it could have far-reaching implications for India's energy landscape. India has ambitious plans to expand its nuclear power capacity, and rightfully so. Nuclear energy offers a cleaner and more reliable alternative to fossil fuels, especially as the country grapples with pollution and climate change. But building nuclear power plants requires massive capital investment, which is where foreign players come in. Opening up this sector could attract billions of dollars in investment, accelerating India's transition to a cleaner energy future. However, there are valid concerns about safety, waste disposal, and the potential for proliferation. These are complex issues that require careful consideration and robust regulatory frameworks. If India can address these concerns and create a transparent and accountable system, the nuclear energy sector could become a major growth driver, attracting both domestic and foreign investment. Alright, let's get down to brass tacks. You're probably wondering, Divya 9, what are the hottest investment options I need to know about? Well, let's break it down. First up, we've got the stock market, the OG of investing. With the Indian economy booming, investing in companies listed on the National Stock Exchange or the Bombay Stock Exchange can be incredibly lucrative. But remember, high returns come with high risks. It's crucial to do your research, diversify your portfolio, and consider your risk tolerance. Next, we've got real estate. India's ever-growing population and rapid urbanization are driving demand for housing and commercial spaces, making real estate a potentially lucrative investment. But be warned, real estate is illiquid and requires significant capital. Then there's gold, the classic safe haven asset. Indians love their gold, and for good reason. It's a tangible asset that tends to hold its value, especially during times of economic uncertainty. You can invest in physical gold or opt for digital gold, which offers more convenience and security. Don't forget about mutual funds, a great option for beginners. These are professionally managed funds that pool money from multiple investors to invest in a diversified portfolio of assets. Mutual funds offer diversification, professional management, and are relatively low risk. We also have bonds and fixed income securities, which are debt instruments issued by governments and corporations. They offer regular interest payments and are generally considered less risky than equities. But keep in mind that returns are usually lower compared to stocks. Cryptocurrency is another option, but it's highly volatile and speculative. While the crypto market has the potential for high rewards, it's crucial to understand the risks involved and invest only what you can afford to lose. Startups and angel investing are gaining traction. Investing in early-stage companies can yield astronomical returns, but it's also high risk and requires a certain appetite for risk. Peer-to-peer lending platforms connect borrowers directly with lenders, cutting out traditional financial institutions. While P2P lending can offer higher returns than traditional fixed deposits, it's crucial to choose reputable platforms and understand the risks involved. Index funds and ETFs are low-cost, passively managed funds that track a specific market index. They offer broad market exposure and are a great option for long-term investors seeking diversification with minimal effort. Lastly, we have sustainable and ESG investments. These investments focus on companies that prioritize sustainability and ethical practices. ESG investing is not just about doing good, it's about identifying companies that are well-positioned for long-term success in a world that's increasingly focused on sustainability. Now let's talk about a trend that's been gaining serious traction lately: the rise of medium to long-duration debt funds. These funds invest in bonds with longer maturities, which means they offer the potential for higher returns, but also come with higher interest rate risk. Think of it this way: when interest rates rise, the value of existing bonds falls. So if you invest in a long-duration debt fund and interest rates go up, you might see the value of your investment decline. But here's the thing: we're currently in a low-interest rate environment. Central banks around the world have slashed rates to stimulate their economies, and this trend is expected to continue for the foreseeable future. This makes medium to long-duration debt funds particularly attractive because they offer the potential for higher returns compared to short-term debt funds. Plus, they provide a hedge against inflation, which is expected to pick up as economies recover. However, it's crucial to remember that interest rates won't stay low forever. When they eventually start to rise, long-duration debt funds will be more volatile. So, it's essential to consider your investment horizon, risk tolerance, and overall financial goals before diving in. Alright, let's talk about something a little more speculative but potentially very exciting: stocks under 100 rupees, often referred to as penny stocks. These are shares of companies that trade at very low prices, and while they can be highly volatile, they also offer the potential for massive gains. Now I know what you're thinking: Divya 9, penny stocks are risky. And you're absolutely right. These companies are often small, relatively unknown, and their stock prices can fluctuate wildly. But here's the thing: within this vast universe of penny stocks, there are hidden gems. Companies with solid fundamentals, innovative products or services, and the potential for exponential growth. The key is to do your research. Don't just blindly follow the hype or invest based on rumors. Look for companies with a track record of revenue growth, a strong management team, and a compelling business model. Investing in penny stocks is not for the faint of heart. It's crucial to have a high-risk tolerance and only invest what you can afford to lose. But for those willing to do their homework and navigate the risks, the rewards can be substantial. Finally, let's talk about Google's 2025 report on consumer behavior and how it's shaping the investment landscape. Google, with its vast data and analytical capabilities, has its finger on the pulse of consumer trends, and their insights are invaluable for investors. One of the key takeaways from the report is the continued rise of digital consumption. The pandemic accelerated the shift towards online shopping, entertainment, and even healthcare, and this trend is here to stay. This means that companies operating in the e-commerce, digital payments, online education, and telehealth sectors are well positioned for continued growth. Another key trend is the growing importance of personalization and convenience. Consumers today expect tailored experiences, instant gratification, and seamless interactions across all touchpoints. For investors, this means looking for companies that leverage data and technology to personalize their offerings, optimize the customer experience, and provide convenient solutions. Google's report also highlighted the increasing focus on sustainability and social responsibility. Consumers, especially millennials and Gen Z, are more likely to support brands that align with their values and are committed to making a positive impact. This presents a significant opportunity for companies operating in the renewable energy, electric vehicles, sustainable fashion, and ethical food sectors. Investors looking to capitalize on this trend should consider adding companies leading the charge in sustainability to their portfolios. So there you have it, the hottest investment trends that are set to reshape the Indian market in 2025 and beyond. From the influx of foreign investment to the rise of domestic sectors, the potential opening of the nuclear energy sector, and the exciting world of penny stocks, the opportunities are endless. Remember, investing is a marathon, not a sprint. It's about making informed decisions, diversifying your portfolio, and staying focused on your long-term financial goals. Don't forget to do your own research, consider your risk tolerance, and consult with a financial advisor if needed. The Indian market is brimming with potential, and by understanding these trends, you can position yourself for financial success. Please subscribe, like this video, and share it with your friends.